through which the commodity trading is done. And I think, I don't mean to speak for John, but I think the issue that's being raised is not the question of whether the CFC has a legitimate use. It's whether there is sufficient disclosure of the underlying CFC operation.
Yeah, I'd really just like to second what Bob was saying. The reason that CFCs are used by registered investment companies is a tax reason at the registered investment company level. Again, this is not a tax reason that is being used by mutual funds to be cute, to get around tax laws, or to nefariously hide any sort of income. It's far from it. As Bob was alluding to, commodities investments by registered investment companies are not qualifying income under IRS guidelines, which could cause mutual funds to lose their tax treatment that's beneficial for our investors. If they lose that pass-through tax treatment, then they get taxed at the fund level and the shareholder level. And the IRS and the SEC has been comfortable with these structures. So I would just, really just second everything that Bob said, that there is no intent for those of us that use these structures to hide or not be fully transparent about what they do. If there are those that think that additional disclosure is required, we're certainly open to that conversation. I would lastly just add, I want to just make one caveat on some of the statements I made right before the break, because it was really Fidelity's approach to filing for our CFCs under 413A4. I should stress that it's my understanding that others do take a different approach, and there are those that have the view that, and I'm not sure what the right answer here is, but there are those that have the view that CFCs, the subsidiaries themselves, are actually not commodity pools, and therefore there is no need to make any filing whatsoever for those entities that they're covered under the 4.5 exclusion.
Okay, Peter.
Just to chime in, similarly to Matt, I think what was illuminating about the earlier discussion is that there appear to be a wide range of practices with CFCs. Our practices sound very similar to what Matt's described. To the extent we have CFCs, they are part and parcel of the top tier fund. And with respect to key control aspects of the way our products are run, from a board oversight and governance standpoint, from a disclosure angle, the way we think about transparency, risk control, monitoring. You really can't find a distinction between the top level product and the CFC. I think it's all part and parcel of the same. To the extent that there are practices elsewhere in the industry that don't provide that level of transparency or disclosure, I think that would make sense to bring everything up to a level playing field.
Carrie?
I would like to go back to what Matt said before about looking at this from a holistic point of view. I think this might be why some take the idea that the 4.5 covers both the fund and the CFC for registration purposes. But in following on what Peter said, this is really one fund. It's only for tax purposes that it has to be split into two. And so funds look at it as if it is all one fund. When you're thinking about disclosure, as in disclosure to, I would parse disclosure to investors as opposed to information available to regulators. To me, disclosure to investors is, what are the risks involved with my investment? What is my fund doing? And how is it going about achieving that? But not in super granular detail. They want to know the basics of how all this happens. From a holistic point of view, the nuts and bolts of the CFTC, I would argue, are not as relevant. Maybe available in the supplemental materials or something like that, but that's not the heart of what they're getting. The fact that they're doing it may be a risk disclosure, that they're investing in a Cayman Islands fund and that there's different regulation or something like that, but I don't know that it's subject to the same type of disclosure that John's talking about. However, for a regulator to oversee what's going on, I think you do need a different level, and that's why I think the books and records and that kind of transparency is very valuable for a regulator to make sure that things are operating in the way that the funds are representing and what they're saying is being done. So as you're thinking about what the new rules should be, think about whether this is disclosure that goes to investors and how much they need and want, and then whether it's something that you need from a regulatory purpose, because I think the answers may be different and it would drive different outcomes in terms of where you finally come out.
And just to tie that back, from the investors level, obviously, the sort of the flow up of the fees from the underlying CFC and the fund pools that they invest in, the management performance fees, gearing, and things that John mentioned. That's the type of thing that an investor would want to see and we'd like to see. And I think ICI has talked about working up into the fee table and that type of thing.
It reminds me of what my tax law professor said about 30, oh my God, that many years ago. And that is that tax evasion is illegal. Tax avoidance is a right, which I always had trouble with. But nonetheless, I think that's what I'm hearing here is that as long as the rules allow for it and the rulings allow for it, have at it. So CFCs are okay, but let's have more disclosure.
And I think, again, I don't want to reiterate a point I made earlier, but I think the reason why we are focused on this issue is that the 25% investment is the driver of the returns of the vehicle, at least those that call themselves managed futures mutual funds. And that's not typically the case in a mutual fund, even one that invests its assets across a number of asset classes to derive a balanced return or otherwise. But again, it may be at 25%, so with less than half, obviously a quarter of the assets of the fund perhaps are in the CFC, but that investment is the driver of the managed futures returns. And again, there are exceptions. There are funds that can split their commodities investing, so some of it's inside the CFC, some of it's outside. But I'm not casting aspersions on the concept of the CFC. I'm saying given its importance, its critical importance to the returns that investors are seeking from their investment in the fund, the amount of light that you can put on it and the amount of explanation and disclosure you can get around what it's doing can only help investors.
Steve.
I would just say, at least in the case of our funds, there's full disclosure of the strategies and the risks. It's the same as in the fund. I mean, it's carried out through the sub for tax reasons, and it's clearly disclosed in the prospectus. Also, the risks of having the offshore subsidiary are disclosed, and the holdings are consolidated. I mean, you see everything. The results of the sub's operations are included in the fund's operations. We test compliance at the fund level, basically disregarding the subsidiary with the exception of seg assets where we do it at the sub level. And then also with regard to fees, there's full disclosure and we waive all fees. So essentially, I mean, we would rather not have the sub. I mean, it would be less costly to not have the sub, but for tax reasons, we need it in order to have good income.
Can I just ask John, you said that mutual funds don't get all of their returns from a sub in the same way that these do. And just take issue. You could have a fund, a balanced fund that says it's going to get, a small slice from a money market fund and half of the rest from a balanced fund and half of the rest from an equity fund. And you would not find the disclosure saying this is the equity fund, this is how it operates, this is the leverage of the equity fund. And then the same thing for the balanced fund. You get it all together. This is what our fund is doing. We may invest in other funds that provide these returns, but you don't get that level of detail. And I guess I'm still struggling with why it should be different in this case.
I think that it comes down to, for example, in the example you've used, the fund's overall goal is a balanced return from a series of asset classes. If it achieves that through funds that are either registered or otherwise, you're going to get the whole representing the sum of the individual investments. In the case of a managed futures mutual fund, you can more or less ignore 75% of the fund's operations. Now, some funds do more or less with their fixed income side than others to try to accentuate the fixed income returns. But a fund that says managed futures in its name is driving, and its objective and its purpose is to drive managed futures returns for shareholders. And so it's really the only part of the entire portfolio that is actually driving those returns that are the central investment focus of the fund. That, to me, separates it from a fund that invests in other funds in order to achieve a broad objective. And in this case, and to Steve's point, it is the character of the investment in the CFC is different than the character of the investment of the remaining 75%. They're as different as night and day. You've got fixed income securities in the 75% piece outside of the CFC, and you've got investments in underlying funds or with separate accounts and CTAs and other devices that are designed to drive managed futures returns. So you really have extremely different purposes between the two segments of your portfolio. And I'm saying we're kind of allowing the disclosure to be consistent with the idea that this is just 25%, when really what you want to say is this is it. and everything else is basically liquidity for the vehicle.
I guess I disagree, though. It's to me, maybe it's just coming down to identifying exactly where it's coming from. But at the end of the day, the investors' returns and the risks and the strategies and everything else are the blend of everything in that fund. And so, if the primary risk and return is coming from the CFC, then those risk disclosures and the strategies will be, this is what our strategy is, and this is where our risks are. And they may not say this comes from the CFC part of it, but the investor will know that's what they're getting and what they're not getting. So maybe it's a little bit more about semantics and trying to track through where everything's coming from. But again, I go back to, from the investor's point of view, do they care which segment of the portfolio it's coming from, when at the end of the day, the risks are a part of the blend and the returns are part of the blend?
I mean, before we had the offshore sub, before there was a need for it, we did the same thing in the main fund, and the disclosure was exactly the same as it is now, with the exception of the disclosure about being able to do that through the sub and the risks of having that sub.
Do you
But other than
invest
that,
your
it's fully
I'm sorry.
transparent.
I apologize. Do you invest the sub in underlying funds that have their own expense structures and CTAs and separate fees?
No, the sub is just used for doing the activity that would give rise to bad income.
And there are a number of managed futures mutual funds, and I got to be quiet because Bob deserves a chance to talk. But I do think there are funds in this room that do things directly that pose far fewer transparency/opaqueness issues than I'm raising with respect to the examples that I'm using. But I think it's a distinguishing element that the funds that we're really focused on are having to do pooled investing underneath the CFC. The CFC is not the investing vehicle per se. The CFC is a conduit to a series of underlying investments that have their own fees, their own advisors, their own structures, their own conflicts, their own gearing, their own leverage. And those are the things that we want to see much more brought up into the overall disclosure document for the reasons I was saying earlier.
I'm going to jump ahead of Bob just to say that we agree with that I think what we talk about mostly is when it's a wholly owned subsidiary, and it really is as if it is the fund. If the tax laws were changed, it would be done exactly as it is within the fund. So,
And I think two issues. One, I disagree in part with John's characterization. There are a number of funds that trade managed futures directly through the CFC, so that is one structure. The structure John's referring to is the CFC investing in some underlying pools. And to some extent, I agree with what his characterization of the need for full and fair disclosures. Look, this is about materiality. What is material to the investor? And Carrie's point is that if you look at the fund holistically, from the top down, if you disclose all that's material about that fund's operation, concerned about.
To get an IRS ruling today in this area, what representations, Matt, I'm going to start with you because you seem to know everything today anyway. But no, in all seriousness, what are the representations that are required for you to apply or get the IRS ruling? And the reason I'm asking this is what I'm potentially hearing here. I'll even hold my hand out, show my cards. Is that maybe this is a place where we need to undertake more dialogue with the IRS as to how these things operate.
Well, thanks, Kevin.
I'll warn you ahead of time.
I'll take that as a compliment. I don't have a copy of our private letter ruling in front of us, and I frankly can't answer that question in detail. However, what I can tell you is that you're required to basically represent that the parent fund is going to be compliant with the 40 Act, that the subsidiary, as I mentioned earlier, itself will be compliant with Section 18F and the guidance under 18F relating to coverage and the consequent restrictions on leverage that can be used in the fund. Again, that needs to be made at the subsidiary level and at the parent fund level. Other than that, I would be happy to work with you guys, after today and try and get you some more information to the extent you'd like that. I don't know if any of my colleagues have anything else to add.
Anybody want to add anything on that in terms of the representations that have to be made for those? Okay.
There's an express representation that the CFC will comply with 18F, which is the senior security. And then there's also the 25% limitation. I'm not sure if you put that in. I read these last night. There may be some more that I'm forgetting, but I know those are also in there.
How is the 25% calculated?
Oh, shoot. I shouldn't have opened my mouth. Matt, do you know?
The bottom line is
I don't-
you can provide that for the record. But I'm sort of curious about how that is calculated because
We'll
of
get
my
back to
earlier
you on-
discussion on
We'll
percentage.
get back to you on that one as well, Kevin. But there are a series of other regulations that they're under tax language. It's called regulated investment companies, also RICs, must comply with, and there are tax diversification tests and the like that will apply, including this 25% restriction. But we can follow up.
Anybody up here have anything more on the CFC issue? Anybody out there want to say anything more about the CFC issue at this point? I think I neglected books and records earlier, even though I touched on them tangentially. I didn't get into great detail on books and records. What areas may we harmonize with respect to books and records, and how, what kind of thoughts do you guys have? No, Matt, you don't get to start this time. I'm going to start on this side of the room. Although it carries between
See, I wasn't turning my light on because I was afraid I would get the same thing. Mutual funds, by and large, keep their books and records with their service providers, who are the ones that are handling those records. So, for example, custodian has a large amount of them, but there may be transfer agents, there may be other service providers that do as well. Through a written agreement with those service providers, it is agreed that the records are the records of the fund and that the service provider will make them available to the SEC or regulators as requested. And we would suggest that the same be done for these types of funds as well. As far as I know, there's never been a problem with the SEC getting the records because the service provider has failed to or been unwilling to provide those, but that could be something you could ask them in your dialogue with the SEC.
I guess it's my turn now. So I would agree with everything Carrie just said, and I would just add, I know that we've made this point before, registered investment advisors are required to disclose in their Form ADV all of the locations of their books and records, so it's no secret and it's publicly available information. It's already out there. So again, we'd like further leeway as far as where you can hold your records. We do hold them. Company like Fidelity, we have offices all over the country and in fact globally, and we hold our records in all of our different offices and in offsite with third-party service providers. The other sort of related point that I would make on this is investor access to information of the commodity pool, and it's something that we probably need to understand a bit better. It's CFTC Rule 4.23, how this would work in practice. But one of the concerns that we have is that if investors have the ability to, at a moment's notice, get access to the holding information of any of our funds, that could create selective disclosure issues under SEC rules. Not sure how those two are squared together, but there are prohibitions on that registered investment companies must follow on selectively disclosing information on portfolio holdings to their investors.
On that, I was going to lean either towards Dan or anybody from the commodity side with respect to your experiences with someone asking to inspect their books and records. Last I had heard from most of the commodities bars that they never had one. Anybody come in and request it. What's your experience?
I haven't been with the company as long as we've been in business, but I'm not aware of any such request actually being made on us.
So maybe there's no need for the rule.
Thanks.
Yeah.
We have had a request from a limited partner to inspect some books and records in a very specific case. They didn't cite the statute, or the rule, but we recognize that we had an obligation to deliver per their request. So.
Dan?
And I don't remember that. I can't remember any single instance of it coming up either.
Yeah, it's. I hear your point on that too. Most of the time it's with respect to inspecting the trading. If the trading of the principal is available for review, and that's where I've seen it come up the most, which is a rule you didn't mention. So there's that. With respect to 18, I think it's 18-96. Staff, help me.
It is.
1896. We've got. I don't know if you're familiar with that, but we've got a rule out there that applies to, I believe, wholly offshore. I'm sorry, it's a letter advisory. that applies to fully offshore entities that we've had in place for several years now, and Dan's nodding since 1996, in fact. But make a long story short, if you are familiar with that, would that solve the problem if we open that up for these types of entities? And that may be something you need to respond to ex post facto.
Agreed. I'm not familiar
Could
with
you
it,
give a
to be
little more
honest.
detail about the letter?
Yeah, 1896, my recollection, and maybe I should have Eileen talk about it more, because I think she's dealt with it more, if she's willing to. Do you want to?
Well, I would have to also refresh my memory a bit, but I mean, it deals primarily with entities that are offering pools entirely outside the United States, but are located or have some, business conducted in the United States. And there is a provision in there, so it basically deals with exemption from most of the requirements that would apply to CPOs, but it does have a component that deals with books and records. And I honestly would have to go back and reread it as to the details of that, but I think that might be the part that could apply. But I had not considered that in this context, prior to now. So
it's my understanding of 1896 that the relief that's given is we're permitting these entities to keep their books and records offshore instead of onshore, as opposed to necessarily, I don't know that it necessarily contemplated the use of a third-party service provider for maintenance of those records, but at least it is a consideration that we've dealt with in the past, and it may provide a way forward.
Staff has been nodding their head no to me, but I also remember at a time when we were in the old building. For me, I have to mark time when what building I was in with the CFTC. But I remember a letter that we issued, and I thought we issued many of them, that allowed onshore persons to keep their books and records at a location that was not their main business office. If it was one of their other entities, let's say they had 3 offices, one in Colorado, one in Virginia, and one in New York. And New York was listed as the main business office, they could keep it at one of the other locations. But again, it's not exactly a third party in the classic sense, but it's what I'm suggesting is maybe there's a room for us to move in that direction. Dan?
Well, from NFA's viewpoint, by the way, there are other classes of commission registrant that don't have the same restrictions. So FCMs are allowed to keep their records in more than one spot. They just have to disclose. So it's different for pool operators than it is for other classifications. As far as we're concerned, in order to do examinations and get information quickly, we need to be up to date on where the records are. That's the most important thing. And
It is most important.
and not so much
Where
it's at the home office.
Okay. So that's one that I think, again, we may be able to consider. Allison?
Yeah, I was just going to say that I think disclosure is certainly important. You should know where the records are. But I think, certainly speaking with my Franklin Templeton hat on, we have trading operations that are in different places than where our advisory entity is located. So, we're going to have records, depending upon what the issue is, in many, many different places, and we're able to get at those very quickly. But to expect that just because the advisory entity is located in one place, that all records are going to be there, I think, is not going to be realistic in many cases.
I think under our Rule 1.31, isn't it 72 hours? And I don't know how that would work for NFA.
Well, we have rules and interpretations that, because we have a number of members that are located offshore in some countries that we probably wouldn't want to travel to necessarily. And there is a requirement that they have to provide they have to tell us a location in the United States that they could provide all of their required records within 72 hours, I think it is.
So we'll take that one under advisement. Other books and records issues. Bob, I'm sorry, Bob.
Yeah, I think to some extent this issue's been addressed in your ETF relief because although ETFs aren't a direct corollary, they, like us, don't necessarily have privity with the underlying client to get books and records of name, address, number of interests held, and so forth and so on. So I would suggest that the ETF model might be one that the staff look at.
If there's no more on books and records, I'm going to move us, if everybody's amenable, I don't think we need another break this soon. Moving on to the real 413 discussion. And Todd, I'm going to let you take your first shot.
Thank you very much,
Starting
Kevin.
from this side, working backwards.
Thank you. A lot of the conversation this morning, I know not directly related to 413, though, is we've crossed over this path a few times. So apologies if I cover some themes at least, which I think have been raised. I'm the non-executive chairman of the Alternative Investment Management Association, known as AMA. We have approximately 1,250 corporate members spread out around 40 different countries in the world. Our membership is also quite diverse professionally, and that's relevant for our comments in that the submissions we've made to yourselves in the SEC over the last couple years and on the Hill before that have been made up of working groups from that broad geographic and professional diversity. So it's very much a hedge fund industry comment that we try to tend to provide. Related to that, in February of 2009, very quickly after the November 2008 G20 meetings here in Washington, D.C., AMA came out with a policy platform to try to be very clear as to where we were looking to become involved in the conversation. We strongly support all the efforts to address potential systemic risk analysis and to improve the transparency to regulators, which we understand really to be the driving force at the G20 and as well with Dodd-Frank in many starting points. This also includes clearly the broader regulatory coverage of certain markets and institutions, not least of which hedge funds. In that February 2009 platform, I would just highlight 4 particular points which I think are relevant to today's conversation in 413 in particular. We came out very early and supported the mandatory registration of managers or private fund advisors in the jurisdictions in which they operate. Second, we supported the periodic reporting of systemically relevant information to those supervisors, and we use our language very carefully. We think focusing on the advisor, which came out earlier in this conversation, is appropriate, and we think on focusing on systemically relevant information to improve the FSOC and other type of analysis should be the key focus here. Third point, very important for a global industry like ourselves, we called for and supported the G20 call for a globally consistent and coordinated approach in this exercise. Indeed, anything that deviates from a coordinated and consistent approach to our industry simply represents increased marginal cost in trying to comply with what's happening, given that we're involved in so many different countries. Our managers, we have investors all over the world, trade in different markets. If we have to file in different jurisdictions, the costs ring up quite quickly. And then fourth, something I also heard mentioned earlier this morning, we came out and supported de minimis thresholds, that the marginal cost for smaller managers and mid-sized managers to come up with some of this compliance would be significantly great. And the information, quite frankly, that they could contribute to that systemic risk analysis is not that material and to what we think is the end game. So those principles have really driven at AMA our thinking over the last 2.5, 3 years in dealing with Capitol Hill, the SEC, the CFTC, Treasury, the Fed, and others involved in this conversation. Now, with regard to 413 and the proposed elimination of the exemptions under A3 and A4, if you follow those principles, we have a number of concerns that we've raised in particular in our letters. First, very simply, as proposed, advisors in the United States and internationally, and not just private fund advisors of a hedge fund type, but much broader, would be subject to multiple and in very many cases different registration and reporting regimes. And as I said earlier, this simply rings up for us a marginal cost conversation. We support the regulatory objectives, particularly as it addresses greater transparency and improved systemic risk analysis, but we believe that those objectives can be realized in a more cost-effective and regulatory effective way. In the United States, the CFTC and the SEC have repeatedly said they're looking to implement substantially similar regimes, or the language I think is often used, regimes creating substantially, putting regulated entities in a substantially similar situation. And we support that, but we think that increasingly that's not where we might end up. We see very different regimes emerging between the CFTC and the SEC. And then when you extrapolate that internationally and look at the UK FSA, you look at Hong Kong, Australia, and Singapore, which are advancing relatively faster than many other jurisdictions, and now the EU, which is also chiming in on a regional level, that overlap and difference begins to become quite significant. With regard to specific requests and proposals, we have very simply asked the CFTC to consider that they provide registration exemptions similar to the SEC. It could be done in two very broad-based ways. You could exempt any advisors that are already registered with the SEC or that have been deemed exempt from registration with the SEC. And with regard to that second aspect, you could therefore use the private fund advisor exemption proposed by the SEC or the foreign private fund advisor exemption with respect to non-U.S. managers. Either one would get us to that final point. With regard to reporting, we've also requested and proposed that the CFTC and the SEC work together much more closely, whether the outcome is something looking like Form PQR, PR, or PF at the SEC. We're relatively neutral, but we'd like to see one form begin to come together and be consolidated between the two agencies. If that's not possible, we'd like to see one agency take the lead and then basically attempt to share that information between the two other agencies and ultimately, of course, with many other agencies as it goes up through Treasury into the FSOC process. We think whatever reporting regime emerges, it needs to have two very distinct goals. One for tracking what's happening in the industry, which we think can be very basic information filed annually and updated annually, and the other for the systemic risk analysis. On the systemic risk analysis, we think the old 80-20 rule is still very much appropriate to think about here. And we believe it's something the SEC is also doing with their work. Where I understand the SEC, where they may be looking at gross exposures rather than net exposures within the management companies and their funds, are still looking to get about 75 to 80% coverage of the industry as they gather information for the FSOC process. In the United States today is approximately 240 advisors with $1 billion or more of assets under management on a net basis. But they represent 82% of assets under management in the hedge fund industry. So through that simple 80-20 process, you begin very quickly to get a targeted group where you can get a very representative sample of what the hedge fund industry can contribute to the FSOC analysis. And finally, on reporting, we encourage the CFTC and the SEC to work together to develop common thresholds and an information focus of the information gathered. Similar to what we see emerging in the UK, Hong Kong, Europe, and elsewhere, there seem to be distinctions drawn around managers anywhere from 0 to 150 million of AUM, where very little information is gathered, or what I refer to as tracking information to find out who's in the industry, what strategies are being followed, and what trends they can gather from small funds in the industry. This also represents only 3 to 4% of assets under management in this country, and it's pretty much a similar number globally. The second threshold tends to be a number between 150 million, or in Europe 100 euros, and 1 billion AUM. Here you have about 15% of assets under management in this country by the hedge fund industry, and we think something approximating Schedule A of Form PQR would be appropriate with the elimination of some of the position level data that is currently included in there, and probably updated annually, because once again, the purpose would seem to be to track what is happening in the industry. And then finally, for the $1 billion club, the $1 billion AUM and up managers, that is where we see Schedule C having most application, where we would encourage it to be updated semi-annually, 30 to 45 days after the period, not 15 as proposed, and the information would very much focus on tracking systemically relevant information, as is currently the goal under Form PF, and certainly what's been implemented for a number of years at the FSA. So I'll be happy to answer questions based on that.
I think next out of 413 was going to be Mark with your opening comment.
I'm going to try to cut down on our comments. Thanks for the opportunity to participate today. My name is Mark Baum, and I'm the General Counsel and the Chief Compliance Officer for Serengeti Asset Management. Serengeti oversees investments predominantly made in North America that are focused on sector dislocations, uncovered or misunderstood opportunities, and liquidations. We're based in New York City. I've spent 25 of my 27 years as a practicing lawyer in-house at regulated financial services firms, from broker-dealers through banks, through hedge funds. That's my context. I'm here today to speak on behalf of the MFA and its members. I believe that the participants here are familiar with what we do, and we've introduced ourselves today and what our activities are. So I'll jump ahead. MFA has consistently, as you know, supported intelligent and well-informed regulation of the U.S. securities and futures markets through the Dodd-Frank legislative process. We also have consistently endorsed the notion that our regulators benefit from market and participant information and appropriate funding to be able to discharge their regulatory responsibilities effectively. We are very concerned, however, with the Commission's proposed rescission of private pool exemptions because we believe, by and large, the exemptions have worked, and the rescinding them would require many registrants that are now or will be subject to SEC registration to become duly registered with the CFTC and subject to redundant, unnecessary, and inefficient regulation. Dual registration can be excessively burdensome for registrants, though especially for smaller ones like Serengeti. As the Commission and the SEC's regulatory compliance requirements, as has been noted, may be similar but still differ in many respects. We believe that with respect to private pools that have an investment advisor registered with the SEC, rescission of the private pool exemptions is unnecessary to achieve the public policy objectives of Dodd-Frank. That the preservation of private pool exemptions is consistent with current law and interagency comity, and that the Commission still will receive information it needs from the new Form PF, the SEC, and exchanges, even if the Commission retains the private pool exemptions. MFA believes that the Commission should work with the SEC and other members of the Financial Stability Oversight Council to implement an information sharing framework for systemic risk data, and we've said that. And the Commission should review and analyze Form PF data before considering whether rescission of the private pools exemption is necessary. We think that such information will help inform the rulemaking process, if necessary, by providing the Commission with information on the number of market participants engaged in trading commodity interests and the scope of their activities. We have also provided the Commission with some alternatives to rescinding the private pool exemptions. Specifically, with respect to 413A3, we believe the Commission, under an information sharing framework with the SEC, should retain the exemption in 413A3 for a pool that is not engaged primarily in trading commodity interests and that has an investment advisor registered with the SEC. We believe that this recommendation is consistent with Dodd-Frank, which attempts to minimize dual registration, as demonstrated by the preservation and expansion of the exemptions from advisor registration under the CEA for advisors not primarily acting as a CTA, that do not act as a CTA to any commodity pool that is engaged primarily in trading commodity interests. The Advisors Act contains similar exemptions. In our view, consistent with Dodd-Frank, a pool operator should not have to register with the CFTC as a CPO if its commodity pool is not engaged primarily in trading commodity interests. Also, given that the Commission has a great deal of information on private pools, such as through Form PF, larger trader reporting, and swap data repositories, we believe the Commission will have the information it needs to oversee its markets. The costs, as have been noted, associated with rescission of the private pool exemptions would greatly exceed, we believe, the limited benefits from dual registration. We have proposed in letters to the Commission and in our written submission proposals on possible tiering, ranging from de minimis, as Amy has discussed, to a broader regulatory structure. I'm happy to discuss that if necessary. But again, MFA believes it makes the most sense for the Commission to retain 413A3 for a pool that is not engaged primarily in trading commodity interests and that has a registered investment advisor. Thank you.
Thank you, Mark. I think next on 413 was going to be Dan.
And Carol really summarized NFA's view on 413. I'll reiterate that NFA has always been a big proponent of 413A3, asked for it for a number of years before it was actually adopted. And before that time, as Ananda mentioned with FCMs, if a fund did just one futures contract, it raised the specter of having to register as a commodity pool operator, and we don't think that makes any sense with regard to the use of regulatory resources. One or two sort of related things. Under the current 413A3 and A4, there's a requirement to file an exemption notice with NFA at the time you're claiming the exemption, but there's no follow-up required. So we really have no way of knowing what the status is of all of the 12,000 entities that have sought an exemption. So we fully endorse the Commission's proposal for 4.5, 4.13, and 4.14 to have an annual recertification of qualification for any exemptions you have. The last thing, which is just one of my personal pet peeves, is it hasn't happened a lot, but there have been a few entities and individuals that filed for exemptions under 413, A3, and A4 who prior to that had their CFTC registrations revoked or have been tossed out by NFA. And if you could find a way to make those types of entities ineligible for the exemptions, that might be a wise thing to do.
Martin, you're up actually the last panel, but since you're here, you're the last person, I think, to give an opening statement, so why don't we give it now? Unless you'd rather hold it till later.
I don't really need to make an opening statement. I'm here to represent the Private Investor Coalition. I'm a partner in a private law firm. They're my client. And unlike the rest of the people here, I think I'm here to give you information about the family office world.
Exactly.
And why they deserve an exemption.
So we'll hold it till that issue actually comes up. And as you can see, we have the relevant person from the SEC who just finalized their rule on family offices. So if we have any problems, hopefully she can help us out. Okay. With that, my first question on the 413 actually goes to, again, the threshold issue or the calculation. If we were to maintain some sort of a de minimis test, what should that de minimis test be?
Bigger than we are. No.
Much bigger than you are.
Much bigger. Much bigger.
Well,
No,
this came up earlier in the context of 4.5 as well, and I have some concerns anytime we use percentages, just for your benefit, because percentages of bigger numbers can be bigger numbers.
Absolutely.
And so I'm not a fan of percentages, and that's why I'm asking: is there anything else out there that we might be able to consider?
So we offered a de minimis percentage rule. I'm sure there are actually other ways to measure this. The tension is you're always going to be dealing with funds of vastly different sizes. So I don't know how you can get fully away from something in there and let you know. And I don't think absolute dollar numbers make sense either for the same reason.
I would approach it this way. I think you need to have two objectives: tracking and systemic risk. And they're very distinct and different objectives, and I think what you gather and how frequently you gather it will be very different if those are your two objectives. The second would be, I think for simplicity purposes, well, let me back up. If you think of the evolution of this process in different parts of the world, the UK probably stepped out first and Hong Kong second, and they had an ambition when they started to gather all kinds of information, tremendous amounts of information from tremendous amounts of firms. And they quickly realized that they got into information overload very quickly and began to fear that they were perceived in knowing a lot more than they actually did because they had so much information sent to them so frequently. So from your perspective, I think, and I have a sense that the colleagues from the SEC have moved in this direction because of an internal conversation in the SEC as to whether to use NAV or gross exposure, that it's almost a non-starting conversation because the endpoint is the same, and that is they're looking for somewhere around 75 to 80% of the industry to provide systemic risk type reporting, which will automatically take you to something approximating 220, 240 type of managers in the United States and about 400 globally. So I'm backing into your answer is another way of saying it. So therefore, if you want to take $1 billion AUM on an NAV basis, you're done. If you want to do it on a gross exposure basis, you're going to have a larger number, but you're still going to end up with about 200 to 220 reporting entities of what you call Schedule C, or the SEC calls Form PF.
Okay, I want to approach this in a very delicate way because we're concerned about. I know why you're concerned about 413 and who is or is not there, because it will drive who files the form. Okay, we were planning on not being concerned today about Form PF and Form PQR, but I think I understand why you're raising it is because if you're in, and you have to file the form, and that's where AMA's concern is the most, and not who's being regulated.
Well, who's being regulated? You have to define what regulation is, and regulation here really is oversight and not regulation per se. I would call it more you're trying to learn what's happening inside these entities and look through these entities to markets and make a risk analysis. At least that's what's been happening with the FSA and in Hong Kong, where there's relatively more experience. That's where they've ended up.
So let me just posit this as sort of a devil's advocate kind of thing. If there were not a data collection instrument being proposed, PF, PQR, whatever, then everything else doesn't matter to AMA?
No, I wouldn't say everything doesn't matter. We were asked this question actually very early in the House process on Dodd-Frank, and we said we provided public comment that if you wanted to register everybody in the industry, we would not oppose that. It's what you do with registration which begins to drive up significant marginal costs to our members.
Yeah, so, in addition to the comments I made about 4.5, I also represent the IAA and obviously have a constituency with respect to 4.13. But certainly, from our standpoint, I think that we are very willing and able to provide whatever regulatory reporting is necessary for you to monitor systemic risk. So certainly, I think Form PF goes a long way towards that. I think PQR, if there's additional items of information that are needed to address your monitoring concerns, that's something that we could certainly live with. I think our concern, though, is with conflicting regulations, substantive regulation. And so our position has been that, with respect to the Advisors Act, it already provides a robust framework for many regulatory issues. And so our concern is not seeing conflicting regulation on the CFTC side, but certainly on the reporting side, we're willing to give you what you need.
Hi, and we would echo that. We're very happy providing information. I mean, we've been in it at both commissions. We've had issues around the frequency because we've tried to make the frequency make sense given other parts of our business, and that came up in the 4.5 conversation. But it really is the issue of dueling regulatory. It's not an information issue. We perceive this as an issue of you all getting the information that you needed, and we trying to operate under one logical, consistent regulatory framework.
Dan, I know it's hard to, because we don't have the second side of the aging test yet, it's hard for you to determine how many people will be out there that may come back in if we do 413. At the same time, do you think we're going to have a large migration back in, or or are they going to migrate to 4.7?
Well,
or change their business model?
About 12 questions there, Kevin. So I'll see how many.
I intentionally did that, Dan.
How many of them I can try to deal with. As I said, I think there's 12,000 entities that have filed exemptions, and it's close to 30,000 funds. And almost all of those came in since 2003 when A3 and A4 were adopted. And since that time, we have had a reduction in the number of pool operator registrants and members. I think that maybe they went down by a total of 500 or 600. So my best guess is I don't think you're going to see 12,000 firms coming in, but you could potentially see 400, 500, 600 new firms come in, sort of undoing what happened over the last 8 years.
Given the fact that there may be more of an undoing than a new population coming in, isn't it likely that they already know how to handle the regulatory regime? Maybe unfair to ask you that, and I should ask the other persons on the panel. But
well, if we're presuming that there are firms that were registered before, yeah, I guess that's true. We do point out in our comment letter that if you do away with A3 and A4, there needs to be an ample amount of time so that firms can actually assess their business, determine what they want to do, give them time to staff up if they need to staff up, give them time to actually go through the registration process, ask questions. So I don't think it's, personally, I don't think it's so much that they don't know how to deal with the regulatory process. I am empathetic to the fact that, you know, nobody wants multiple regulators. If everybody could have one, they might prefer that. So I don't think it's without cost, but I don't think it's so much that they just don't know how to deal with regulation.
in the NFA letter, if I remember correctly, I think you said earlier, either you or Carol mentioned that you do support the continuation of, in some form, A3 and A4. A3, just A3? Okay, just A3, sorry.
Well, and we haven't asked for the repeal of A4. We were just silent about that in our letter.
Okay. In that context, is that largely due to a field, and I think you mentioned there, is that from the audits that you've done at NFA or
yeah,
what?
I mean, over the years, we've dealt with having all of these, a lot of firms out there that because they're registered and members, you have to go do examinations, you have to spend time on them, and we didn't feel after many years of doing that, and now I'm not talking about cost benefits for the industry, I'm talking about cost benefit for the regulator, that it just didn't seem to be the wisest use of our resources. And of course, the same holds true for the firms, so it just magnifies that cost benefit analysis.
Okay, I think I have Todd and then Mark.
A couple things. Maybe first back with Dan. When you said 4 to 5 or 4 to 600 may migrate, who are they? Are they U.S. firms? I mean, what do they look like? Because we were asked that question as well by Amanda and Kevin, and so we had an initial number, and sort of a process of full registration with SEC/CFTC versus getting into an NFA world. We had people say to us so interestingly, not the U.S., but UK, Hong Kong, Singapore, and Australia, 3,000 to 3,500 entities, not just hedge funds, but asset managers broadly, would have to do something in the United States because of either their investor population or they trade futures of some incidental number, and they'd be caught up. Subsequent to that conversation, we were asked to go back and look harder at that number, and so we expanded it throughout Europe, looking with a number of European entities, and that number's grown to something in the 5,000, 6,000 range.
And it was a shot in the dark when I said the numbers I did, and it only reflected the change in the membership since before 2003. Now, obviously, in 8 years, there are new entities out there that would have that didn't exist before 2003 that do now. So there's nothing scientific about me saying that.
And I think when we're playing, yeah, sorry.
So I would just indicate that I don't think that all 12,000 would come in.
Yeah.
Certainly it's less than that. And then of course, when you add swaps to the mix,
That's right.
that adds a lot too.
And we
So
don't
it's
know
hard.
that, yeah.
I think if somebody's got a really precise number, that's great, but I was just taking a shot.
Our
And
estimate,
I think the other thing I'd ask you in terms of your numbers, because when we start throwing numbers around in this industry, it's sort of fascinating because it depends on what we're counting. In year 600, I think was commodity pool operators. Your entities may have been
Swaps.
the entities operated by somebody, and so there could be
our numbers,
So his pool, there could be four pools per commodity pool operator, which would be 2,400 entities. And yours, I think yours was the number of entities.
advisors.
Yours was the number of advisors,
Advisors.
which is again different than ours because
Right.
a CPO could have 5 or 6 advisors.
And we did consciously ask the question, commodity interest has been redefined for swaps. You'd be caught if you have investors in the United States and/or you trade relatively insignificant number of futures in the United States. And so that's where that number came from. And we not only bounced that through our national groups, but we actually talked to public authorities, regulators in those countries. And the numbers, these are all estimates, so I totally agree with you there. And so they're taken with caution. But we double-checked through the public authorities, and they thought the numbers were rational.
And right now, your number, since you actually surveyed the swaps issue, that's probably the only number we've got right now that's even tied to anything. Mark, and then Matt.
So responding to a couple of points. One, we were going to find out part of this when registration occurred over at the SEC. That's been put off for a little bit. But to Dan's point, no, I think what we have to understand is since 2003, there's enormous change within one of the things about hedge funds, very dynamic business. Historically low barriers to entry, and huge numbers start each year, huge numbers fail each year. And so you're going to be, and in fact, much of the industry was gearing up for regulation for the very first time, putting aside the 80-20 part of this. So I think if you're living in the 80-20 part, this is a marginal change. It's not very big. For lots of the rest of the business, and I've worked in big places and small places, and $1 billion is still small to me. This is the first time they're gearing up for being regulated at this moment. They do not have the internal expertise. They are developing that internal expertise. And in fact, industry-wide, for real compliance with this kind of stuff, there is not nearly enough industry expertise. People were wondering whether there was enough for the SEC regulatory system. It is marginal when you add on another set of regulators, but there's not remotely enough experience across the entire business to service both of these, unless there is, in fact, if you choose to implement it, a large period of time just to train people in order to do this.
I'm going to go off the sheet here for a second, because what just hit me a little bit in terms of particularly because of Todd and Mark's conversation, is that what we've got is two head. Again, I'm thinking about my cascade, but I'm thinking of two heads here. One is the registration process, and then the other is everything else that follows on because you're registered. Okay. And what we're talking about primarily is harmonization with the SEC on the everything else. And even though we didn't intend to have the data collection as part of that, it's important. It now flashed in my brain maybe a little later that we have these two sides or two heads. In that context, and not, I don't want the rest of the panels, the rest of the day to go into the PF and the like. Assuming there has to be a data collection, of the other regulatory issues, those that need to be harmonized, what is most important? And if a couple of you just want to give me your 1, 2, and 3 of that to help me out, because I know a couple of you would make the data collection 1 from what I'm hearing. Okay, but other than the data collection, what would be 1, 2, and 3 with regard to 4.413 or 4.5?
I'm not sure I fully understand, but let me try to answer it this way.
Okay.
Number one, we would encourage you to ask yourself right there next to the SEC, what is it you're trying to achieve through the process of both registration and reporting? And I think the answer will be you want to have a greater clarity of who's out there in the industry as an advisor. That's what I call tracking. That's getting on your radar screen and gathering basic information. And I think second, and I think in all fairness, more importantly, is the systemic risk analysis aspect of this feeding into FSOC, where my 80-20 rule, I think, is going to be applicable. In fact, it's probably something closer to 10% of the industry providing, 80% of that. And so it's a very different approach, Kevin. And let me just clarify something I said earlier. Registration, we've never been opposed to, but we're not supportive of many different types of multiple registration, certainly in the same country, but ideally not even registering in 3 or 4 different countries. So we certainly would like to see one registration worked out between the CFTC and the SEC, because some of those same people will have registration requirements outside of the United States, and then you multiply that concern through examination and reporting processes if they are also different time frames, different data, and different thresholds to who has to do what.
That's helpful. Maybe I can help clarify. Amanda's helped me a little bit with what I'm trying to ask, I think, here. One is, okay, you have to register. Once you register, then you have other requirements, i.e. disclosure, reporting, record keeping. Part of the reporting is your financial reporting. The other part of your reporting would be the data collection that we're talking about doing, okay? Assuming that the data collection is a fait accompli, which you don't want to assume, but assuming that's the case, of the other 3, are the harmonization issues mostly in disclosure? Are they mostly in reporting? Or are they mostly in record keeping? If we were to expend limited resources in trying to harmonize the issues in those 3 areas, where would our time at the staff level be spent best?
I would say all of those things. That's the tension. I mean, what you're looking for is, can I sort of try to restate for a second? So start at the beginning of the process. Start at the registration statement, the basic information about the firm. It could be the same form about the basic information about the firm. If you harmonize and say, here's what you're doing for SEC registration, here's what you're having to do for SEC and CFTC. It's the joint SEC-CFTC form. And then you go, everything sort of begins to lead from that. And so what you're looking for is figuring out, to the extent you can harmonize in all of those areas, because it shouldn't be, for registrants, it shouldn't be that different. None of these things should truly be, this is an age-old tension, that different. But, it starts with, if you started on the information and think that, again, the burdens for smaller firms to give you everything you want are much greater than the burdens for bigger firms to give you everything you want. And that's where this gets complicated, which is when you have, even on Form PF, this has been the ongoing conversation, it's this thing that, as the D. Shaws of the world begin on being, within their firms, and they've talked about this for MFA, they begin to figure out how long that's going to take them and what their needs for personnel are for that. That vastly different issue, same information request to a firm much smaller. And so all of those things, to the extent that you have to, you're figuring out what is this additional information you really need? Do you truly need it?
And why?
And then if so, we're very happy to work with you if it can get distilled in a way that we can actually give you information that's helpful. Sorry.
All right, I can talk loud.
Okay.
Theater, so that's not a problem. I think are we all off?
No. It seems I'm not talking. Okay, I'll turn myself off.
Shut us off. Nonetheless, I will do what I can, and hopefully the reporter can hear me. Okay, now we're better off. I guess we can only have a limited number on at the same time. All right. Again, we're sliding off into the data collection instrument, and I'm hearing you. I'm hearing what you're saying with respect to the data collection instrument, but I'm also trying to focus my resources on what I need to do. Now, I will tell you, just to disabuse some people at the table of a couple of things that I've heard today that trouble me greatly, is that you have down here a person from one part of SEC who's working on a team she's done most recently the family issue that's come up, but she's also been working with the team that's done the data collection. You've got Doug from the team that handles the 4.5 issues, and we've been talking about harmonization. I've also been talking with David Vaughn, et cetera, with respect to harmonization and Form PF. We've been working on that data collection form since, I think it's now it'll be 2 years in October. Not on that form per se, but on the data collection instruments, starting with FSA and IOSCO. Okay, we've been working for 2 years, and in fact, I'm going to the IOSCO TCFUE meeting on August 2nd. All of this stuff is flowing together. In terms of harmonization on that, we have been working on the form at a meeting where we haven't met on the form together with also the other members of the FSOC. And so this issue that the FSOC hasn't talked to us, we've met with those people on the FSOC on a regularized basis, okay? So it has been harmonized. And so likewise, we've been talking with Doug about harmonizing other stuff. That's why I want to try and get down to the nitty gritty. I don't want to know its disclosure generally. I want to know its disclosure item on this issue that we need to fix. Its disclosure item, this issue we need to fix. Because we have been going round and round and round. There was a harmonization panel, I think was mentioned by the Chamber of Commerce, which actually wasn't part of this rulemaking process. That was directed by Congress and needs to be addressed separately. So it doesn't make this a violation of the APA. Nonetheless, we have started with that harmonization conference, which I think David Vaughn was on it, and Doug as well. We've had meetings on this on a regularized basis. And I think what's troubling me is we keep coming back to the same point. We have generalized areas, but give me the specifics as to what we need to fix. Okay? And sorry for that little bit of getting on my soapbox, but I feel us going around and around on the same points. Now some of the things I hear we're fairly close on. And I think, depending on how things go, we'll see what you guys think in the end. But bottom line is, what are the specifics?
That's very
okay?
fair.
And coming back to Form PF and PQR, that's not the point today. For another issue, for another day, tell me line item by line item what you don't like or what you think is inconsistent with the SECs.
So Kevin, well, I can't give you a line item by line item analysis, which I know is what you just asked for. What I can say is that from the disclosure standpoint for investment advisors, for the last number of years, maybe even going back 10 years, as we were talking about with Doug earlier this morning, the SEC has been working on changes to Form ADV. And finally, we've gotten the changes adopted. And so we're now trying to absorb those and distill those and figure out how those are going to apply to us. So I think from the investment advisor standpoint, we're trying to focus on how to comply with these new rules, and to have another layer of additional rules I think would be very challenging at this point. So I mean, from the advisor's perspective, I think that that's currently what we're dealing with on the disclosure side.
Can I just make a
Yes.
procedural issue? 3 to 4 microphones seems to be the limit. So if we can try to keep it to 3, it seems like 4 might have triggered the outage. So just.
And I appreciate that comment, but I will tell you that one of the things that we will do on our side is we are looking at the things that have just been done by the SEC, and we will bring ours into line with what they've been working on to the extent that it's appropriate, or that we don't have a definitional difference because of our statute. Some of the issues that arise are actually statutory definitional differences, and some are regulatory definitional differences. To the extent we can make the fixes, we can make them. But we may not be able to fix all of those little minute things, but we'd like to know line by line what they are. Okay? And again, that's for, we said records open for 2 weeks. But that's really what we're looking for here. And same thing with harmonization. You've helped a lot here, because there are some specifics that I've gotten today. I've got 3 pages worth of specifics that we can work on and work out in greater detail, some of which we've already discussed with Doug. And so I think we're working along those lines. So even though I may have sounded nasty there, I don't mean to be too nasty. With that, anything else in the 413 area that you want to raise? A3. 413A3 area right now. A4 is coming up later.
Can I quickly make a comment? Actually, yeah.
Sure.
So I really, just to tie it all together, I fully support the idea of maintaining a de minimis exception for 413A3. I think that that's something that should be implemented in any rule change here. We discussed a little bit earlier on the 4.5 panels this morning. It's our view that any changes or any carve-outs rather that are included in a change to 4.5 should be considered equally for changes to 413, both A3 and A4. But when we're talking about things like resource requirements and cost and the like, and just thinking through some of the numbers that Dan threw out at the NFA, and this was a point I was going to raise earlier. I'm glad that Todd and Dan hit upon it. Now that we add swaps into the mix, I don't know if the numbers of exemptions that are on the books today are adequately going to capture the marketplace of who could be required to file under a revised 413. So you're talking about a lot of potential players. And it's an interest to us at Fidelity because we have an institutional management business. So we manage other accounts other than mutual funds, commingled pools, ERISA accounts, and the like that use other exemptions here. But we do rely on 413 as well. So again, it's an interest to us, and I think that it certainly makes sense to think about the scope of the potential filers and to appropriately adjust whatever final rule goes into place here to pick up those categories that you think really require that additional level of oversight.
Just you asked the question: reporting, disclosure, books and records, harmonization. Where are the priorities? And just to back up what Mark said, we're not trying to overreach, but the answer really is as much as possible harmonize. It really is, and where I would take that to the next level of the conversation is, and I apologize, I'm repeating myself in some respect, ask what it is you're trying to achieve. If it's just tracking who's in the industry, we understand that. Registration goes one large step to get there, but not all the way. Use some form of relatively basic, annually gathered type of information to track who's in the industry, what strategies are being pursued, how the growth of the industry is going on, because that's relevant information for you and for FSOC for that matter. And then secondarily, if your information is much more on the systemic risk side, which is where I read most of the G20 calls, the Dodd-Frank calls, that's a very different approach. And so when I look at Schedules A, B, and C within PQR, I do see substantial differences from PF, not least of which is on the threshold side. There are very small people may have to provide position-level data to someone like yourself under Schedule A, which they would not have to do under PF because they wouldn't be caught at all. They might even be an exempt advisor under the SEC approach. And the SEC has an exempt advisor reporting approach, which maybe I'm wrong, but I've broadly described as a tracking mechanism to see who's in the industry because the information is basically so basic. So I apologize, but go back to what is it you're trying to achieve through the everything above registration.
I appreciate it. We'll take a longer look at Schedule A, see what's there, because that does help. Believe it or not, we were scheduled to take a break now for 5 minutes, and we're exactly where we were supposed to be. So we're taking a 5-minute break. When we come back, we will be talking about 413A4, and starting off with the family office issue, and then the foreign commodity pool operator issue. Okay, if everybody wants to take their seats, so we'll go through the final round. Okay, I want to start this panel off with the family office issue. And what is the family office issue? In at least one comment letter that I'm aware of, if not multiple comment letters, okay, it was raised that by doing away with 413A4, what would happen to a family office? And how did, or should they be exempted, or did they fall, what was going to happen? And as I mentioned, that our colleagues over at the SEC have already dealt with the family office issue. And so I guess the real question is, in terms of what we're working on, one of the thoughts is, well, we could just adopt what the SEC did, or by cross-referencing it, or are there still issues? And so with that, I guess I would turn it over first to Martin. Are there other issues that still need to be addressed in this area?
How about if I answer that, but not make it the very first answer?
Okay, however you want to handle it. However you want to handle it.
So let's start with describing what we're talking about, because it seems to me you're, more than anything else, and I think Sarah and Doug would say the same thing, is that you are missing information, and you'll make much better decisions if you know what you're talking about.
Absolutely.
Okay. It usually turns out that one or more persons, through their economic prowess, has created wealth, and when they have progeny, the family will want to preserve the wealth, share the wealth with their children. Usually there's charitable and community involvement, so there's a lot of good reasons why families band together. It isn't necessarily that they start in the first generation. I'll use real people so that we make this not hypothetical. But Bill Gates' father wasn't the one who founded Microsoft, but Bill and Melinda certainly are a family office. And the Gates Foundation certainly is a charitable foundation that is of some consequence. Bill has been generous to his parents, his grandparents, and his sister, and his children. But if you count generations, it's him, and then you have to count generations up to see what the family actually looks like. Others that started much more earlier in our economic life, ones in the 1800s, there are families who made the things that plowed the prairie and gave us corn. Those families had family offices starting in the 1880s. The one I'm thinking about formed a corporation, put all the shares of the family company in the corporation, something that every lawyer at this table would gasp at. But you have to remember, it's 1880. That they thought that was a wise idea, and we didn't have income taxes until 1910. So it seemed perfectly sensible to them to do it that way. It causes lots of problems, and the two of them know both statutes are apply to that situation. So they're a very interesting client. Others, the family wealth was there, and there is a patriarch, someone that you can point to, but they didn't decide to band together until the second and third generation. So in family office parlance, when you ask about it, the first thing they usually tell you is where they are, and they'll talk about G2, G3, G4. It's the first, second, third generation from the person they're thinking of as a patriarch, and he may have been the one who created the family wealth. He may not have. You can look at the Rockefellers and figure out what Senator Rockefeller would be compared to his great-grandfather. To the extent that you're talking about family offices, you also have to sort of think of volume, and I'm going to use, it's easier to talk about compass than it is anything else. Almost always, whoever created the family wealth will take care of his parents, maybe his grandparents, but of course he's more likely than not to be married, so you have a spouse and her family coming into the family office. They'll take care of all of their siblings, so down one or two generations, you end up with aunts, nieces, nephews, because everything gets populated north, east, south, east, and west, and then obviously what you're doing is counting how far down. We have one particular family office that didn't get formed until they were all at the G4 level. So every single person was a cousin. They had common ancestors, but no common parents. I mean, immediate parents. Sometimes the family office was formed by the patriarch, and he was there to protect his family. So he set up trusts, and when the children died, their part of the wealth was made part of the family office. And so the thing that owns the family office is a trust that gave an irrevocable trust from the early 1900s or 1800s that gave the money to the family office. Others have been formed at sort of the far end where professional managers have told the family, it's really insane for you to all invest alone. You should invest together. You'll have much greater buying power, and we can deal with you better that way. So the person who formed the family office is actually the professional management. Most families don't manage their own money. That is, the family members aren't involved. And when you get to the third, fourth, and fifth generations, the difference is that the first person may have been immensely wealthy personally, but usually by the time you get to the third and fourth generation, the difference is they all go to work somewhere, but they have very nice vacations, and they might have a boat and a bigger house than you would otherwise expect. But when you look at what the family's got, we're still talking about a lot of money. So before you were trying to get demographics, the group I represent is a coalition that was formed out of the whole family office industry. There's 60 of them. I couldn't guess at the average assets under management per family, but it has to be in the billions. There are 2,500 family offices in the United States, and I have no way of measuring what the effect is. But as we've period. Family offices have bumped into the Investment Advisors Act routinely, and they bumped into your statute. And I'm not going to tell you about your law. That's not my business. But on the Advisors Act side, we had a lot of rubber. You could find ways. There was an exception for private investment advisors, and we all got used to counting to 14. You could use your fingers and your hands, but somehow you had to find a way to get to 14. And if you did, then you would, all other things being equal, you could rely on the private advisor exception. So, of course, Dodd-Frank threw us out, along with private equity funds, hedge funds, and venture capital funds, by repealing Section 203(b)(3). Private family offices many of them have grown beyond a size that could have supported counting to 14, no matter how creative you were in doing that. So folks like the Rockefellers and the Pitcairns have given up on being a private family and have started what both Sarah and Doug would characterize as a business. And indeed, they've formed mutual funds and done all sorts of things. And there are companies that manage assets for private families, including companies like Bessemer Trust, U.S. Trust, and Northern Trust. So there's all sorts of ways that they can manage their assets and work their affairs. At the end of the day, the family office almost always does all the tax returns, all the personal accounting, and they may or may not have anything to do with the actual investments. Their role may be limited to looking at private investment alternatives, hedge fund prospectuses, and then letting the family choose, or they may have sub-advisors who choose. There's lots of different ways they manage their wealth. It all depends. We have one family in Florida who almost all the families have some sort of core asset. And if you think of it the way John Grady would, they've got a core asset that's some part of the S&P 500. So the last thing they're going to do is go out and replicate. They're never going to buy S&P 500 index funds because they already did that with the company that was their family wealth. So you tend to find them in the 50s and 60s being the people who were the seed capital for Infotron or Genentech or something like that. Well, they went to some other part of the risk spectrum, right, to offset the balance, the S&P 500 risk they already had. The point is some of them outgrew Section 203(b)(3), and I, among others, filed exemptive applications with the SEC under what was then Section 202A11F, and our argument was that there was no federal interest in regulating the family. The family office existed solely for the family. It was for the benefit of the descendants of some common ancestor, and they were much more likely to take care of themselves and take care of each other than others would be. There was no compelling federal interest, and I would have said one of the ancillary benefits is you didn't have to have spats between brothers and sisters in federal district courts where the SEC would show up as an expert witness on whether or not spitting on the sidewalk was a breach of fiduciary duty, right? I mean, they got rid of them, and that I always thought was a really good thing, all other things being equal. Then at least it was in divorce court or the orphans court or something. There were at least 12 or 13 of those applications that were processed between 1940 and the time of Dodd-Frank. There was no ability to get an exception for family offices in the House bill, but there was in the Senate, and it shows up in the initial drafts of the Dodd bill as Section 409 and stayed in. There was only one amendment that was made. It was on the floor of the Senate by then Senator Lincoln, who put in a grandfathering provision that's completely incoherent and had to have been written on the back of an envelope by one constituent who didn't know what he was doing. But it's there. Otherwise, everything was the same from the beginning. CC had no, I'll speak for you, but you can speak for yourself, had no interest in regulating family offices, and so it was one of the few times when I've worked on something where there was no opposition. But they did want, and the statute passed with rulemaking to define what was a family office. So that's what you alluded to. All right, for rulemaking purposes, once you've said family, then you've actually got to figure out what that means. And in our modern times, leaving aside everything else, there's a whole lot of social policy questions that prop up that are not a lot of fun to deal with. And we, I think, managed to get all of that out of the rulemaking. Otherwise, we would have had a dispute about what DOMA means forever. Okay, so it's fairly standard. I mean, and you bounce up against practical problems. If the organizing principle is everything's connected by blood and you're all lineal descendants, as soon as you have a non-blood relative, it gets a little harder to explain why that's a really good idea. So stepmothers, adopted children, stepchildren, gay and lesbian children, all the normal social problems are right there. And once you hit any one of them, if that's all has to depend on lineal descendants, you basically have a circuit breaker, and that is difficult. Okay, so I was very grateful that from the beginning, the SEC staff showed real sensitivity to that. And we processed an exemptive application with probably the worst set of conditions in it, of factual conditions, basically in order to give them an opportunity to handle that. It was done deliberately on behalf of the community. So it was husband and wife, they got a divorce, kids go with the mom, he remarries, she comes with children, the children are in their teens. And at that point, it is very hard to explain why you have to adopt them. They are stepchildren, they're living in the house, but in the greater scheme of things, the point is that if the wealthy husband takes everybody into his house, it's pretty hard to explain why Advisors Act policy should explain who's part of the family and who's not. And gratefully, we didn't have to have that conversation, and there was only two really rogue and random comment letters in the comment file that they had to deal with, so that was good. But after you figure out what the nuclear family is, then you have to figure out what the rest of the family is. So the way we always proposed it was to figure out who the person you wanted to point at was. And you can't say it's the person who created the wealth because he wasn't necessarily the one who created the family office. But you've always, to the extent that anybody here is married, you know you've got another side of your family you inherited on the day that you got married. So if you follow life down through descendants, you have a spouse whose family thinks she belongs in the family too. So you've got to find a way to deal with mother-in-law, sisters, brothers, all from the non-ancestor side of the family, and siblings. So it's north, south, east, west. Families preserve their wealth through a lot of different things, usually trusts. There are a lot of different ways to set up trusts. Many families support foundations. I'll name the one that's the most obvious, the Bill and Melinda Gates Foundation. Is not only their money, their personal money, but at this point, it's Warren Buffett's money that comes in a segment every single year, and that they must spend every single year. I'm not saying anything is in the public record, so you know that's why I keep using them, and everybody knows them, so it's easier than trying to make up a mythical family. But the point is, families support all sorts of foundations. Some of their own personal foundations, some are the things they feel strongly about. Almost everybody, if you've done your own personal estate planning, discovers that if in all of the imaginary lawyer discussions about who's died, you have to make everybody in the family die in one horrific, hypothetical plane crash or car crash. Then what do you want to do is always what the person says, and not surprisingly, people frequently don't want their money just to escheat and pay off the debt of New York State or the United States. They would like it to go somewhere else. And so you often find charities. So one of the distinguishing features about this is tax-exempt institutions who are both income beneficiaries and remaindermen, but are not clients in the sense that there's any investment advisory relationship between the family and the foundation. That's not true of Bill and Melinda Gates, but that's something else again. And then there's always people who invest. In the same way that you had a discussion earlier about subsidiaries, that's exactly what people do. If you want to develop a strip mall, you create a limited partnership. It has a general partner. The general partner is normally an employee of the family office or a member of the family office. That general partner decides what the limited partnership does. The limited partnership offers its interests to the family. No one has personal liability. It's tax planning efficient. So, but you look around and there's all sorts of stuff. And in the old days, we used to have to figure out how you counted that stuff towards 14. In the last application that was processed, the staff was gracious enough to buy into yet one more concept, which was that it's very hard for family offices to keep their employees unless you can offer them incentives. And so we argued that the key employees, who are the ones actually involved in developing the investment advice, to the extent the family office did that, ought to be allowed to co-invest with the family, and that was allowed. So family turns out to be more complicated than you might think. It's not only the nuclear family, but all the people who become part of the family, looking north, both sides of the husband-wife pyramid, and its siblings. So you get nieces and nephews, and then down, where you look south, and then all the ways in which the money's invested, because the family's actually giving investment advice in some respect or another to all of those things. You asked that comment at the beginning. We've had the family office rule for a couple of weeks. We've had a number of meetings. We've had a lot of conversations about it, and I've been quoted publicly as saying, and I believe it to be true, that the division is to be congratulated. They went from a rule that, with all respect, was 100% unsatisfactory, or some other number higher than that if you can do that in math, to a rule that was 90 to 95% satisfactory. There are things that we're still mulling over, and I've opened the door to more discussions. Now that the rule's been adopted, the rulemaking period isn't there, and we can go talk in a way that is a little more comfortable. But more than anything else, I'm going to do a plebiscite, so we'll know amongst and get information. So we'll actually know this problem doesn't work for 65 families. This problem doesn't work for 100 families. This whatever it is. So I don't want to characterize things as didn't work. There are things that I think there are, again, with all respect, are probably drafting errors, where there's a singular used and the plural makes more sense. That's one thing. There are things where parts of whole families disappeared because of the genealogy and the way they define the term ancestor. We may have to ask for some sort of amendment to deal with that. As I said to Doug before, we live in Washington. There's 88 keys on the piano. Well, we can figure out which way to deal with each problem. But it's not over, and thankfully the extended period for compliance means that we've got 9 months to figure this out, and there's really no one who's going to be opposed to any of this. We've also, for whatever it's worth, just so you know, the Representative Hensarling and others have submitted a bill in the House. It's H.R. 2225 that would deal with family offices. And to cut to the chase, it would take away the SEC's ability to define the term family and would put in instead a definition of family that's more like what's patterned more the way we did it in our comment letter. And that's just, all the things being equal, that's what you would always prefer your own work. But and then I won't even begin to comment on the likelihood that something that comes out of that committee can get passed in this Congress or any Congress.
Thank you very much. I don't think you could have been more thorough than that. I appreciate the time you took to put that together. And I think it helps us, and it may help the SEC as well. And what I would ask, though, is that anything you plan on sharing with the SEC, if it's in the near future, or even in the longer future, please, if you would not mind sharing that with us as well, so that we can take the benefit of your knowledge in this area.
And as we continue to work and consider whether or not our adoption of a family offices exemption would be appropriate, I know that I will be in contact with you if that is all right.
That's fine. I actually did that a cappella without written preparation.
We're going to have a transcript.
I understand.
So.
That's why I did it.
So we appreciate that.
Yeah, so if there's anything you need to correct, it'll.
No, what I didn't want to do is just read something to you, so.
Yeah, I appreciate that. We definitely appreciate that. Next up on our agenda is foreign commodity pool operators. And I'm guessing that, Todd?
Yes, in large part, I think we've talked about it under the last session, under 413 in many respects, where I tried to bring it out. The foreign private advisor exemption as proposed by the SEC is something we would like to see applied here. I mean, once again, just to quickly summarize, multiple registration, different multiple and different reporting requirements is what we're trying to avoid. We're trying to avoid it here in this country between the CFTC and the SEC. And then, as I alluded to in my initial comments, you multiply that when you think that another 25% of the industry is in the UK. You add more now with the EU process out of Brussels. And Hong Kong, Singapore, and Australia are also very important jurisdictions in this conversation for our industry sector.
So if I can just, so would your group be comfortable if we were to adopt something that would be substantively identical to what, or at least propose something that would be substantively identical to what the SEC is going to be operating under?
I believe so. Yes, in the sense that, we are not opposed to information sharing and all of that. So if we ended up in a place where, say, a UK advisor may or may not be registered with the SEC for business reasons as well as regulatory, and they do file reports with the FSA and they share them with the SEC, and the SEC shares them with you and or directly or through the FSOC Treasury process, that's the result that we envision as the appropriate end game.
We just one minor point, which is, our issue is to the extent our understanding is the Commission thinks that sort of with this exemption in place, there's sort of certain systemically important pools that might be caught up under the SEC that you're not seeing. The only thing we would say is that, to the extent they fall outside your oversight at this point, we recommend that the Commission figure out, again, it's on this information, figure out how to get the information to somewhere. And if it's at the SEC at this point, figure out how to get it without taking away, without, sort of craft your conclusions here narrowly rather than broadly.
Okay, anybody else have anything on the foreign commodity pool issue? Or 413A4, otherwise generally, or not generally. It looks like I see no red lights coming on, and it's 2 o'clock. So you guys did a marvelous job, and even I appreciate everything you've provided us with. We are truly working towards harmonization, whether you believe it or not, and whether I sound like it or not. But nonetheless, appreciate your time and trouble, because I know this has been, take something away from your regular work day. But we are taking it seriously.